Let me start with something that sounds wrong, and then explain why it isn't. Warren Buffett, the man who controls one of the largest financial empires on Earth, who has studied money longer and more deeply than almost anyone alive, thinks cash is one of the riskier places to keep your long-term wealth. And he's said, in various ways across decades of public letters and interviews, that there are specific categories of assets he considers significantly more reliable for building and protecting real wealth over time. Not more exciting, not higher risk for higher reward, more reliable. Safer in the sense that actually matters when you're thinking about what your financial position will look like in 10, 15, 20 years. Most people find this backwards. Cash feels safe. It's stable. It's liquid. It doesn't go down, at least not in the way that shows up obviously on a statement. But Buffett's whole framework is built on a different, longer horizon definition of safety. And once you understand that definition, the list of things that qualify as safe in his eyes looks completely different from the list most ordinary savers are working with. Today we're going through the 3 categories of assets that Buffett's public philosophy, consistently stated across his entire career, positions as superior to cash for long-term wealth preservation and growth. Not for everyone in every situation, there are always nuances, and we'll be honest about them. But as a framework for thinking about where wealth actually lives over time, this is as clear as anything he's ever said publicly. Let's get into it. First asset, ownership in productive businesses. The single most consistent theme in Buffett's entire investing philosophy, stated more times and more clearly than almost anything else he's ever said, is this. Owning a piece of a great productive business is one of the most reliable forms of wealth there is. Not trading stocks, not speculating, owning, genuinely, patiently, long-term owning, a piece of a business that produces real goods or services, that earns real profits, that has real customers who keep coming back, and that will still be doing those things in a decade. Here's why he positions this above cash, and the logic is worth understanding carefully because it's counterintuitive in the way that all genuinely useful financial ideas tend to be. A great business is not just a number on a screen. It's a living, producing entity. It has employees who show up every day. It has products or services people genuinely need. It has the ability to raise prices over time as costs rise. It generates earnings that either get paid out to owners or get reinvested to create more future value. It is, in the most literal economic sense, productive. It makes things and earns things. Cash doesn't. That difference, which sounds abstract, becomes extremely concrete over long periods. $1 held in cash over 20 years earns whatever modest interest rates allow, loses ground to inflation in most extended environments, and ends the period as a somewhat diminished version of itself in real purchasing power terms. $1 invested in a genuinely great business over 20 years participates in that business's growth, benefits from reinvested earnings, tracks the inflation that would have hurt the cash holding, and often ends the period as a substantially larger real amount. The volatility is real. The business value goes up and down on paper in ways that cash doesn't. And this is exactly where most people make the error that Buffett has been pointing at for 60 years. They confuse short-term price stability with long-term safety. Cash is stable in price. It is not safe in real value over time. A great business is volatile in price. It is far safer in real value over time, if you're patient enough to let the time do its work. For most ordinary investors, Buffett has said, the most accessible version of this ownership is through a low-cost index fund, owning a small piece of hundreds of businesses at once, diversified, cheap, patient. Not an exciting prescription. Exactly the point. The asset that's actually safer than cash over long periods doesn't look safe in the short run, which is precisely why most people don't own it. and precisely why the people who do tend to end up in substantially better financial positions over time. Let me pause here quickly. If this reframe of what safe actually means over the long run is starting to shift how you see your own cash holdings, hit subscribe and like this video. Content that genuinely challenges the conventional wisdom about safety, instead of just repeating it, is exactly what this channel is built for, and the support helps it reach more people who need to hear it. Okay, on to the second asset. Why ownership beats lending. Before we move to the second asset, there's a distinction Buffett has drawn repeatedly that's worth understanding clearly, because it shapes how he thinks about an entire category of financial products. There's a fundamental difference between owning something and lending money to someone. When you put money in a savings account, you're lending it to the bank. When you buy a government bond, you're lending money to a government. When you buy certain types of conservative financial products, you're often in the creditor position. You've lent capital, and in return, you get a contractual promise of repayment plus interest. Buffett has generally preferred the ownership side of this equation over the lending side for most of his long-term capital. Not because lending is bad, it has its place, and we'll talk about a specific case where he thinks it makes sense in a moment. But because the returns available to owners of productive businesses have historically exceeded the returns available to lenders to those same businesses, over long enough periods, and by enough of a margin that the difference compounds into something very large over decades. The reason is straightforward. A lender gets the contractual return, the interest rate, and no more. If the business does brilliantly, the lender still only gets what was promised. The owner gets everything above and beyond the costs, including all the upside of a business that grows faster than anyone expected. The lender has contractual protection. The owner has participation in all future growth. Over long periods, in an economy that tends to grow, participation in growth beats contractual protection almost every time. This is why Buffett's portfolio has been dominated, across his entire life, by ownership stakes in businesses rather than by bonds, loans, or other creditor positions. The cash sitting in a bank account is you in the lender position, lending to the bank, getting interest, no participation in the bank's growth. He wants to be on the other side of that equation wherever possible, for capital he won't need in the short term. Second asset, real assets that produce income. The second category Buffett's philosophy positions as more reliable than cash over long periods is real productive assets, specifically things that generate income in the real world, separate from financial markets. Real estate that generates rental income is the clearest example of this category. Not speculative land, not empty lots hoping for appreciation, but property that someone actually uses, that generates real cash flow every month, that provides a service people genuinely need, shelter, commercial space, something functional. This type of asset has a set of characteristics that Buffett's philosophy values specifically. It produces income that tends to track inflation over time because rents can be adjusted. It represents real ownership of something tangible, and it generates returns that are independent of what financial markets are doing on any given day. The inflation tracking feature deserves particular emphasis because it's one of the things cash explicitly cannot do. When inflation rises, the purchasing power of cash falls. When inflation rises, the income from well-located, well-managed, income-producing real estate tends to rise with it, because the cost of housing and commercial space rises with the general price level. Owning something real that produces income that can reprice over time, this is a genuinely different kind of asset from cash, not just in return potential, but in the structural relationship to inflation. Buffett has spoken about farmland as a particularly pure version of this idea. Land that produces crops, generates real income, feeds people, serves a function that doesn't go away. He's described the comfort of owning something that's genuinely doing something in the world, producing real value, versus owning a financial instrument that's just a record of what someone else owes you. That distinction between doing something and being owed something runs through his entire framework. Now, real income-producing assets, like quality real estate, come with their own complications. Management, maintenance, liquidity constraints, capital requirements that make them inaccessible to many people at certain stages of life. Buffett's point isn't, everyone should buy real estate immediately. It's that the category of real, productive, income-generating assets occupies a different and more favorable position in his hierarchy of wealth preservation than cash does, for capital with a long time horizon. The inaccessibility for some people at some stages is real and shouldn't be minimized. But the philosophical point, that owning something productive beats holding something inert over long enough periods, stands independent of those practical constraints. The entry point most people miss. Here's the practical objection that comes up every time someone hears, "Own productive businesses." I can't afford to buy a business. The businesses Buffett owns cost billions. What does this have to do with me? It's a fair question, and the answer is the part that makes this accessible to almost anyone, and that Buffett has pointed to himself, repeatedly, as the most realistic version of this first asset for ordinary investors. A low-cost index fund tracking the broad market is ownership of productive businesses. When you buy shares in an index fund that tracks 500 of the largest companies in America, you literally own a fractional piece of each of those businesses, their earnings, their growth, their future value. You're not speculating on which one will perform best. You're owning the whole basket, cheaply, broadly, and letting the collective productivity of the economy do the work over time. Buffett has been specific about this recommendation more times than almost any other piece of public advice he's given. He said that for most people, most of the time, a low-cost index fund is the most sensible equity investment available. Not because it's the most exciting option, because it's the one that actually delivers the ownership benefit, participation in long-term economic growth, while removing the risks of stock picking, timing, and the high fees that erode returns in actively managed alternatives. The entry point is genuinely low. You don't need to buy a business. You need to buy a fraction of many businesses, cheaply, through the vehicle he specifically recommends. The minimum investment in most major index funds is accessible to people at almost any income level. The cost is minimal. The approach requires almost no active management once you're in. The barrier isn't financial for most people. It's psychological. It requires tolerating the volatility we already talked about, watching the number go down in bad years without selling, and trusting the long-term logic when the short-term picture is uncomfortable. That psychological barrier is real and shouldn't be minimized. But it's the only barrier that actually stands between most people and ownership in the first category Buffett identifies as superior to cash. And understanding that the barrier is psychological rather than financial changes what you need to do about it, which is less about finding more money and more about building the understanding and the conviction to stay the course when it's hard. What history shows about cash versus productive assets. Let me make this concrete with something from the historical record, because the argument we've been making sounds abstract until you look at what's actually happened over real periods of time. Across the major inflationary periods of modern economic history, the 1970s being the clearest American example within living memory, the people who held the majority of their long-term savings in cash, or cash-equivalent instruments, watched the real purchasing power of that savings decline meaningfully, year after year, for an extended stretch. The number in the account didn't shrink dramatically, but what it could buy did. And at the end of that period, they were measurably poorer in real terms than they were at the beginning. The people who held ownership stakes in productive businesses and real income-generating assets through the same period fared differently. Not because markets went straight up, they didn't, The 1970s were difficult for stock markets too, but over the full period, including recovery, productive ownership maintained and, in many cases, grew real purchasing power in a way that cash holding did not. The underlying businesses kept producing, kept earning, kept providing goods and services people needed, regardless of what was happening to prices. And that production was the foundation for the eventual recovery in asset values. This isn't an argument that productive ownership has no bad periods. It clearly does. It's an argument that over the full cycles that define actual long-term financial outcomes, the pattern has consistently favored ownership of productive things over holding inert ones. Buffett has watched that pattern play out across multiple complete economic cycles over his career. His preference for productive assets over cash isn't a theory. It's a conclusion drawn from decades of direct observation of what actually happens to wealth held in different forms across real, difficult periods of economic history. Understanding that history changes how you feel about the discomfort that comes with productive ownership in bad stretches. The discomfort is real. So is the evidence that sitting through it, rather than converting to cash when it hurts, has consistently been the decision that produced better outcomes over the periods that actually matter. The asset that's under your own control. Here's the third asset, and it's the one that surprises people the most when they hear Buffett mention it, because it doesn't sound like an investment at all. It sounds like advice your parents gave you. Investment in yourself. In your own knowledge, skills, expertise, capabilities, and the ability to generate income that flows from those things. Buffett has said, more than once and quite directly, that the best investment anyone can make is in their own abilities, and specifically that this investment cannot be taxed, cannot be inflated away, cannot be taken from you by a market crash, and produces returns in exact proportion to how useful your skills are to other people. He's pointed to communication skills, specialized knowledge in high-demand fields, and professional expertise as examples of the kind of self-investment he has in mind. Here's why this belongs in a video about things safer than cash, and not just as a motivational afterthought. Cash is vulnerable to two things that are almost certain over long enough periods: inflation, which quietly reduces what it can buy, and opportunity cost, which measures what it failed to become by sitting still. An investment in your own earning capacity is vulnerable to neither. Your ability to earn more because you know more, can do more, or provide more value to other people, this doesn't depreciate with inflation. In fact, it tends to appreciate with it, because your expertise becomes more valuable as prices and wages rise. And it has no opportunity cost in the traditional sense, because skills compound and build on each other in ways that cash cannot. There's a practical dimension to this that's worth being explicit about. For someone who is not yet at a stage of life where they have substantial financial assets to invest, this is not a consolation prize. It's the highest priority move available. The return on becoming significantly better at a high-value skill, or on learning something that opens up new income opportunities, often exceeds the return on any financial investment available to someone with limited capital. And unlike most financial investments, it's accessible at almost any level of starting resources, because the inputs are time and effort rather than money. Buffett has been specific about communication skills in particular, the ability to write and speak clearly and persuasively. He's said this can increase a person's value dramatically, and that it's a skill that almost any effort toward improving pays back multiple times over in career earnings and professional relationships. This isn't just rhetorical. It's his honest assessment of where self-investment produces the highest and most reliable return relative to what it costs to make it. Why most people own zero of all three? Here's the uncomfortable question the video title raises, and it's worth answering honestly rather than just leaving it as a rhetorical hook. Why do most people own zero, or close to zero, of these three categories? The answer isn't that they're inaccessible, though some forms of them are more accessible than others. The answer is that all three require something that cash doesn't: tolerance for a kind of discomfort. And the financial system, the media, and most of the messaging that surrounds ordinary people's money decisions is organized around minimizing discomfort rather than maximizing long-term wealth. Ownership of productive businesses through the market comes with price volatility. The number goes up and down, sometimes dramatically. Most people can't tolerate watching their savings balance drop by 30%, even temporarily, even when they know intellectually that the underlying businesses haven't changed. So they keep the money in cash or near cash, where the number stays stable, and accept the quiet, invisible cost of that stability over decades. Income-producing real assets require either significant capital to enter, or the willingness to be a landlord, or the patience to find and understand specific situations that make sense. Most people find this either inaccessible or more complicated than they want to deal with, so they don't engage with the category at all. And self-investment requires time, effort, and the willingness to delay gratification in a way that spending the same time relaxing or consuming doesn't. Most people underestimate how high the returns on genuine self-improvement can be, because the returns are invisible in the short run and only become obvious over years or decades. So cash wins by default, not because it's the best option for long-term wealth, but because it's the most comfortable one in the present, the path of least resistance, the choice that requires the least tolerance for discomfort today. Buffett's whole career is an argument against making that trade, against accepting present comfort at the cost of long-term wealth. And the three assets in this video are the practical expression of what he'd do instead. I'd genuinely love to hear about this in the comments. Which of these three do you have the most of right now, and which feels most out of reach? Those answers tend to be more honest than most financial conversations people have, and reading them helps shape what we cover next on this channel. The honest nuances, when cash actually makes sense. Let me be genuinely fair here, because a video that said, "Never hold cash, always own these three things," would be giving you a slogan rather than understanding. Buffett himself holds substantial cash in Berkshire, not because he thinks it's the best long-term asset, but because it serves specific, important functions that the other assets can't. Cash makes complete sense for genuine near-term needs. If you'll need money in the next 1 to 3 years for real purposes, living expenses, a planned purchase, an emergency fund, it belongs somewhere liquid and stable, because you can't afford to have it subject to market volatility in a time frame that short. Putting next year's rent money in the stock market is not what Buffett's philosophy recommends. It's what the philosophy calls a setup error. The wrong asset for the wrong time horizon. Cash also makes sense as the strategic reserve he's described before. The dry powder that lets you act when others can't. Specifically during market dislocations, when the three assets on this list suddenly go on sale. That cash isn't passive, it's loaded and waiting. Without it, you can't take advantage of the very situations that produce the best entry points into productive ownership. And there are stages of life and personal circumstances where the balance tips differently than the general principle suggests. Someone very close to retirement, someone with genuinely limited income stability, someone managing health costs or family obligations that require near-term liquidity. These situations call for more cash and less of the other categories, not because the principle is wrong, but because the time horizon and the personal constraints change the calculation. The three assets aren't a replacement for thinking about your specific situation. They're the framework Buffett's philosophy uses to evaluate where long-term capital should live. And that framework consistently lands on ownership of productive things as preferable to holding inert ones, for the portion of your financial life that genuinely has a long horizon. What this framework actually changes. Let me close with the broader shift in thinking that understanding Buffett's framework on this topic actually produces, because it's bigger than any specific asset allocation. The conventional definition of safety in personal finance is about the stability of the number you see. A bank account is safe because the number doesn't go down. A bond is safe because you'll get your money back plus interest. Safety, in this conventional definition, is about what the statement shows you in the short run. Buffett's definition of safety is about the purchasing power and productive capacity of your wealth in the long run. And by that definition, the things that look safest in the short run, cash, savings accounts, stable deposits, are often among the riskiest choices for long-term wealth, because they reliably underperform inflation over long periods, reliably underperform productive assets over long periods, and require you to accept a slow, invisible erosion of real wealth in exchange for the comfort of a stable-looking number. This reframe doesn't mean volatility is your friend, or that risk is always worth taking. It means that the relevant risk to think about, for capital with a long time horizon, is the risk of your wealth failing to keep pace with the world, not the risk of an account balance going down temporarily. Those are different risks. They call for different responses. And the response to the first risk is owning things that produce value, not holding things that are static. That's the framework behind the three assets. That's why Buffett consistently, across 60 years of public statements, has positioned productive ownership above cash for long-term capital. Not because it's comfortable, it isn't, but because it's honest. And because honest reasoning about money over the timescales that actually matter is what this channel is built to provide. If this changed how you think about the word safe when it comes to your own money, give it a like so it reaches someone who's been keeping everything in cash because it feels safe. And subscribe if you want more of these contrarian breakdowns of how the best financial minds actually think. And tell me in the comments, which of the three assets feels most realistic for you to start building? I read them all. Whatever you're holding right now, and whatever you're calling safe, maybe run it through Buffett's definition before you assume the word applies. The one that feels safest today, and the one that actually is safest over the next 20 years, are often, quietly, not the same thing at all.